Hi everyone, welcome to the weekly market wrap up. I will take you all with the key market events, globally and domestically that have triggered the markets, equity markets and the bond markets this week. So, starting off with, giving you a global market update. So, with the number of days passing by, the global economy is sliding more into recession as the Russia and Ukraine war has disrupted supply chains, leading to record high inflation levels. And the central banks have turned hawkish to kind of tame down the inflation worries that is hovering around globally. Inflation is resulting to lower spending of consumers, and because of that, the demand is quite tepid. Lately, in this week, ECB announced a 75 pips rate hike, raising the refinancing rate to 1.25, which is the highest level since 2011, to contain the high levels of inflation that is there in the ECB, which is at 8.6% currently, against the target of 2%. Europe is facing a huge energy crisis as the gas supplies have been halted from the Russian company called Gazprom, which is right now supposedly an indefinite halt, and because of which the volume of gas to be supplied is also of a major concern during the winter months that is coming by. UK Prime Minister, which is newly elected, Liz Truss, announced a cap on the energy bills and a stimulus package to kind of help the citizens, the UK citizens, with the soaring energy prices, right? So it's kind of a relief to the household back in UK, where they've given a cap on the energy bill that the consumer will have to pay for a year, and they've been given a stimulus package to kind of cope up with the energy crisis. Back in India, there are lots of green shoots that we're seeing. So irrespective of the global macro indicators weakening around the globe, India seems to be relatively better placed compared to its peers, with a few Asian peers and the global developed country peers around the world, with strong domestic macros and economic recovery being in place. A few points that highlight strong macro indicators. So India's rise in the global supply chain is expected to be because of the PLI schemes that the government will push, and also because of the China plus one advantage that India will be getting. The services PMI number touched 57.2 in August, thereby indicating that there's a huge business growth, and the momentum is quite positive. Sustained demand improvement, along with manufacturing PMI, which is also going at a healthy pace and in an expansion territory despite inflation headwinds. India has adequate forex reserves of closer to $564 billion, and these reserves are adequate to fund imports despite the volatile rupee that we are standing off as of today, and thus alleviating concerns regarding the balance of payments. GST collections crossed 1.4 lakh crore mark over here in the country for the sixth straight month. So the collections for GST are growing, and it is expected to pick up because of the festive season that is around the corner, and hence all of this is despite the elevated inflation levels that we are sitting on as on today, with the CPI, which is 6.7. So the GST collections are picking up, and this shows that there's huge demand activity in the country. Bank credit, again being a very important indicator for economic growth, witnessed double-digit growth at 14% YOY growth, indicating that we have a good recovery coming in from the post-pandemic, place. So the main driver for the bank credit growth was the retail loans, and followed by the personal loans. Talking about inflation, as I said, 6.7% is the inflation level that we are standing off as on today. We have positive manufacturing and service PMI numbers, which are in the expansion territory. The GDP growth rate also came in at 13.5%, which is again because of a base effect. And we have a positive GDP growth rate, whereas most of the countries globally are having not a great number for the GDP growth rate. Um, but coming back to the equity markets, so the equity markets went by positive for the week, as most of the indices, Sensex, Nifty, the mid cap index and the small cap index were up for the week. And the main triggers for the indices being positive was because inflation has started tapering off for India, and India stands at a relatively quite a positive note. FPI flows turned positive in July and in August, and in August we saw inflows closer to 50,000 crore, rupees. The oil prices have started tapering down, and it is below $100 per barrel. And the earnings calendar for FI, the quarter 1 turned quite positive because of a lot of business positive sentiment that came in. And it would be right to say that quarter 1 of FY23 was the first completely normalized quarter post the COVID disruptions. So we continue to maintain our stance to invest in good quality companies which are fundamentally strong. And we expect that India will have a good India continues to have good tailwinds, and it will definitely recoup as the supply chain issues kind of ease off. So we expect the 10-year GSEC to be in the range of 7.25 to 7.5, and we recommend investing in held to maturity strategies with a medium term horizon of 3 to 4 years. Thank you so much.